our research lead, Sean Hickman, who is joining us from his home office today. Sean, welcome, mate. You are on mute, so you're going to need to press the unmute button.
Morning, James. Nice to be here.
Nice to have you, mate. In terms of the today's webinar, it's coming to the end of the calendar year. It's been a pretty volatile one out there. We were down 109 points yesterday. We've bounced back that and some on the market today. I just got off the phone with a client who asked me, "Is this the start of the Santa rally?" So it could potentially be that one, Sean, but it certainly didn't look like it yesterday.
It didn't, but as I've said a few times this week, it's a dangerous time to be short, but it didn't feel like it yesterday.
Absolutely. Okay, in today's webinar, we just want to get across some of our thoughts around portfolio positioning into the back end of the year. This is the fourth webinar in a four-part series. We've touched on a couple of key sectors of the Aussie market, starting with the resources sector. We also looked at some growth stocks with a couple of good young analysts. We took a step backwards and looked at the hybrid space last week with Cameron Duncan, and there was some really good feedback about that webinar. So that's on the Market Matters website if you want to go back and look at that one. And today we're going to try and wrap it all up with portfolio positioning, present some of our bigger picture macro views, and then give you a few stocks that we're particularly keen on for growth and for income. So before I begin, just a quick disclaimer. Any advice provided today is of a general nature only. It's not considered personal financial advice, and you should consult a financial professional before you take any of the information on board. Just to give you a quick overview of the Market Matters investment team, headed up by myself, James Gerrish, the lead portfolio manager. We've got a well-experienced investment committee, portfolio manager Harrison Watt, and then research lead Sean Hickman, who puts it all together in terms of our bigger picture views and how we should be positioning portfolios moving forward, which is really helpful. Just to give you a backdrop of the performance of the Market Matters portfolios since their inception. So the flagship growth portfolio has done 13.71% since inception. The income portfolio, which is about 60% equities, 40% more debt securities, done 8% with about half the volatility of the market. Emerging companies portfolio is a more recent portfolio, but it has struggled. It is above its benchmark since inception, but its performance in the nearer timeframes have been a little bit low. And then the international equities portfolio has done 15% per annum since inception. So that's just to give you a flavour for our views around the market, and that they are actually populating down into strong investment returns across the Market Matters portfolios. So Sean, today's presentation is going to look at some macro indicators, three of the biggest macro indicators that we keep an eye on. The first one there is bond yields. We've said there they're pointing to a rocky economic times ahead, with the Fed flagging 5.1% rates in 2023. But what's this chart showing? It's obviously the 2-year bond yield overlaid by the federal funds rate.
It's very simple, James. It's telling you that the market doesn't believe the Fed, or it believes the Fed that they're going to push interest rates up to 5.1%, probably in Q1 of next year. But then they're saying we're going to have a recession, because 2-year bonds, and that's not that far away, are trading around 4.3% overnight. And that chart is live. That was from last night, almost a whole percent below where the official rate is supposed to go. So in no uncertain terms, the market is telling us we will get a recession. Central banks around the world are committed to putting inflation back in the bottle, and that is going to really, really slow things down.
So this is a chart that looks at, so when we talk about economists and what they think versus what the market is pricing, it's the same that plays out here in Australia. The market's pricing lower rates generally, and the same is playing out over in the US. So it's a really good chart to keep a handle on. So right now, US 2 years, that's the front end of the curve, are saying that they're going to be lower than where the Fed is suggesting it's going to be. So and that is, as Sean made mention of, is signaling some tougher economic conditions ahead. M2 money supply, US M2 money supply. This is an index that we, or a measure that we like to keep across. It effectively measures the funds in the system. Take us through this one, Sean.
This one's an interesting chart. We've seen over the last 2 years post-COVID, when all the central banks around the world, including the Fed, they pumped huge amounts of money into the economy to stop us going into recession or worse. No one knew how bad COVID was going to be. No one knew how long it was going to stay around. So if in doubt, pump loads of money in the circulation. And if you read any sort of papers and financial press, we saw some crazy prices for assets, whether it be a pair of sneakers, a bottle of wine, whiskey, Bitcoin, growth shares. Asset prices went berserk. Everyone knows what housing prices have done. And that's simply supply and demand. If there's loads and loads of money out there, is looking for a home, suddenly things are, it's cheaper. If I've got twice as much money in my pocket, I can afford that. A price of say 50% higher, it's still cheaper. And we've seen massive asset price explosion. But now we're just starting to see the amount of money coming in supply starting to, I won't even say really come back, but it's stopped going up. And that in itself is enough to slow down equities. It's enough to start saying, okay, for a company's share price to go up, if it's a solid company making money, growing, paying dividends, it won't make any difference. But the companies that are out there on a bit of a pipe dream, and especially asset classes like Bitcoin, they're going to struggle. And that's exactly what we saw last year. But it's only 1 year. If we look at how long money supply has been pushed money in, GFC, COVID, it could last a couple of years. And so I think this next year is going to be a fascinating year. And we could see more of the same that we saw this year, where you want to be generally spending most of the time, not necessarily all of the time, but most of the time in quality companies, not looking for growth levels of optimism, which are probably not going to come to fruition.
So the overall money in the system is going to be less, or the rate of increase is going to be less, and also that money is going to cost more. So the cost of that capital is higher, given the backdrop of higher interest rates. So obviously that creates a negative headwind for asset prices, as Sean made mention of. And just to show that, obviously what we're seeing here is this. The macroeconomic backdrop is such a complex one that we're going to have huge divergence at a sector level across, from markets around the world, from a geographical standpoint, as well as sectors within markets. So, I mean, last year the US market was down, S&P is down 20% calendar year to date. Our market is down 4%. If you include dividends, we're up a touch. Actually, I think we're down now, down about 1.4% after yesterday's move. So there is going to be, but you look at, say, energy is up 40% this calendar year, and tech is down 30%. So there's some huge divergence playing out, and I think we're simply saying that things from a stock perspective, a sector perspective, a market perspective will continue to be volatile. It was a volatile calendar 22, and we think the same will play out in 23.
Exactly. I think one's just got to remain very, very open-minded. What did well last year, what did well 5 years ago, is not necessarily going to do well next year, and especially not all the way through next year.
All righty. In terms of commodities, now we've been pretty positive on the commodities trade over the past 3 to 6 months or so. In the more recent times, we've actually trimmed our commodity exposure back. We're going to get onto some portfolio tilts just in a second, and we'll talk about the material, our skew towards the sector then. But just give us your view around commodities in terms of the here and now, and then if we look out in the next 6 to 12 months, Sean.
I think right here, right now, you have to be careful with saying commodities are going higher. If I was looking at something like copper, for example, which is not on that chart, I'd be more inclined to say it's probably a 50-50. You've got China. China is going into real problems around the pandemic again. If we just extrapolate what happened in the US, unfortunately, the US lost 1.1 million people to the COVID breakout. China hasn't yet had a COVID breakout because they fundamentally closed the country down. They've got 1.4 billion people. So how they're quite going to manage that problem is very, very hard to comprehend. And that in itself obviously takes out the largest part of the demand for the commodity space. We combine that with the fact that markets are already telling us a recession is almost guaranteed for the next year or two. It makes it hard to say commodities are going to go up aggressively from here. So sure, they've already come back a long way. We've already seen a 15% pullback in the CRB index, although some of that blow off top was around the Ukraine time. But my feeling is, on balance, we can see commodity prices drift lower. that obviously that again will be on a commodity by commodity basis, and subsequently we have to evaluate the individual stocks accordingly and the shares accordingly.
Yep. So the start of 2023, we're not overly bullish on our commodities call. That's, I think, one of the other things that we've been writing about in recent times is all around the US dollar as well. Obviously, the US dollar has been a super bullish trade over the course of the year, but it's come back pretty aggressively in the last couple of months. Our view is around in the short term, the US dollar's got this chance of bouncing as well. So obviously the strength in the yen yesterday didn't help that call if you look at the dollar index. But that's the US dollar has been such an influential component of the commodities trade over the past 6 months or so, and we simply think that's going to continue to play out in the first part of next year. But if we do see continued weakness, we've been trimming our positions. We will be increasing our positions to be back into a big overweight position in commodities, Sean.
Oh, absolutely. I mean, that was the next part of this. I mean, I can see next year being a year of two halves. It might not be cut down the middle with 6 months' time, but I do believe the commodities go a lot higher, 2, 3, 5 years out. And subsequently, we will be looking at a position again where we go heavily overweight the sector. They are a cyclical beast. They do have big swings in price. Even BHP has big swings in price. And subsequently, there's nothing wrong with taking a bit of it off the top, like we did, for example, with Samphire Resources and IGO.
Yeah, it concerned me. Like you think a month back, everyone I spoke to was very, very bullish the commodity trade. Super bullish on the ESG type trade, the lithium trade, etc. And you can see how much you can get. There's a point I would stress around commodities is they move quickly, and you can get burnt in commodities. So they often rally more than you ever think they can, and they often pull back more than you think they ever can. So you've got to be active in your exposures around that, and that's certainly what Market Matters will be doing as we go into 2023. That this delves us into a couple of crowded trades. So we flag this, for subscribers that have been following us for a while, will be very across our focus on what's crowded and what's not. So we don't like crowded trades. New subscribers out there will get to know that we look at the investor surveys out there on a regular basis, and we see where the consensus trades are out there, which is, to us, you've sort of got to go against the grain. We're not forceful contrarians, but we think we can make money by having a contrarian slant across portfolios, and to a large degree don't follow the crowd. So you've got there, Sean, fund managers are pessimistic towards economic growth. Is that really new news?
I think it has. It's the front and center. Is it new news? That's a very good way of putting it. Not particularly, but I think it's got more so, James, over recent months. And we saw, again, coming back to that very first chart where we looked at the bond yields, and the Fed are now saying they're going to push rates to 5.1% next year, and yet everyone's now saying a recession is on the cards. So what we should look at from that, all that needs to be looked at from that, we should keep these things simple, stupid. What matters is fund managers are positioning themselves for a recession. So when things improve, it can be quite dramatic, and don't fight it.
Totally agree. And you look at what the RBA, I mean, in FY22, the Aussie economy grew at 3%. In FY23 and 24, the expectations are, or the RBA modelling shows a growth of 1.5% in both of those years. So clearly, this is not, this is the central bank saying this. Fund managers are positioning for this, and this is one of those key things that we often see. And we saw it. We've seen there wasn't a lot of positive news flow out 3 months ago, Sean, and since then the market's rallied 15%. The world was very bearish 3 months ago, and fund managers were positioned very negatively towards equities 3 months ago, and look where they've gone.
Oh, exactly. And it was interesting when I sat down to do these slides last night. This was probably the hardest time to have done it. 2 or 3 months ago, when we went aggressively long equities, it would have been a lot easier to do this, because, as you rightly point out, fund managers were aggressively underweight equities, almost limit short as much as they can be. And we've had a huge squeeze higher, 15 to 20%, depending on what indexes you look at. So yes, they are now positioned for the 74% investors expect global growth to be bad next year, profits to fall next year. So companies that can keep growing, keep doing the right thing, they're going to be really, really well positioned. And that's when it comes down to our job, not just to look at the bigger picture, the index, the sectors, also individual companies. Which companies are going to keep kicking goals, even if we're in a recession?
So that, point 5 talks about cash levels. So they sit at 5.9% compared to the long-term average of 4.9. So it shows that people are bearish, but they were at 6.4, 6.3 or 6.4 from memory. So that was the highest level in 20 years. So there has been this, this incremental change around fund managers reducing cash and putting some money towards equities. But there's still a long way to go to get back to average. And that, the percentage there, 74% of investors who are essentially bearish because they think profits are going to fall, that probably is about right in terms of the collective sense of where the market views next year.
Oh, absolutely. And these numbers could sit like this for 6 months. As we start to see numbers come through and companies report, we get Christmas out the way, New Year out the way, etc. But at the end of the day, this is how people are positioned. It doesn't mean we're going to fight it and go, fight against a recession in the first quarter of next year, but there will be a really, really good time next year to do that. And point 3 is arguably the most interesting one on there, James, because the market is the most bearish towards the US dollar in over 15 years. I think it was like 2 or 3 months ago, it was the complete opposite. And the US dollar was the most crowded trade out there. And we've seen the US dollar fall 10% in a matter of weeks. And that is exactly what we look at Market Matters. We like to know where the crowd is. And when we think it's wrong, and I stress that word when, it's a very big word. When we think they're wrong, we're happy to position ourselves or slowly take a position. We don't necessarily go all in, waiting for that to turn, because when that worm turns, it can turn very, very fast.
I think that's a real a good point to highlight just in terms of new subscribers out there and what Market Matters does. We'll have a view on things. So those will take a position and we'll have a view. So we're not simply articulating what's done on the market in the past 24 hours. We're thinking about how what's likely to come up in the market, how we're positioning around those bigger picture trends, and ultimately we'll have a view on the market itself, sectors within it, and then the stocks that are populating our portfolio. So we're all about putting out a view. It won't always be right. When we're wrong, we'll put our hand up and tell you that we're wrong, and we'll state the reasons why. So that's just, I think, a quick and important thing to stress for new subscribers out there. In terms of our portfolio tilt, I've titled this chart. So basically, it's just looking at what the S&P ASX top 200 and how that looks from a sector point of view. So the weighting, so you'll see there at the top there, the financials are 28.62% of the S&P ASX 200, materials 24.6, healthcare 9.8, and so on and so forth. So you can see what their positioning is now and what they have been like over time. So more importantly, it's what they are now. So the financial index, and then below, in terms of those pie charts, that this is just a quick breakdown of Market Matters portfolio positioning. So in terms of the growth stocks out there, so I'm just going to give you a quick overview of sort of how we're positioned, because some of these the sectors or the segments down below in the growth portfolio need to be combined to give us an overall view. So I'm going to run you through it just quickly. We're only 11% in banks, but we've got a decent position in Macquarie. So we view that as 18% across the banking space, which is clearly unders in terms of the broader financial index, which is 28%. In terms of resources, so the resources space is 24%. If we look at our resources exposure, we're about 27% at the moment. So we were higher. So we did trim Sandfire. We took a really great profit in our growth portfolio, and Sandfire we've still got some of that, and we took a really great profit in BHP in recent times, so we've trimmed the top of that. So, but we're still about in line with the market in terms of energy, and if we combine coal in there, then we're about 8%. The market's at about 6%. Our biggest overweight is in the technology space. So if I look at technology, you can't even see it on the chart there because it's only 2.6% of the ASX top 200. So, and we're at about, if we add software and internet together, we're about 27%. So that's a huge overweight bet in the IT space. It's not that we've held it for the last couple of years and been burnt on the back of this. We've got 1, 2, 3, 4. We got 5 key positions in that in our weightings in the technology space. We've got Altium, which we've held for about 18 months. We're up 26% on it. Hub, similar amount, but we're only up 13%. REA, we've only held it for 3 months. We're down about 8%. Seek, that would have been before today's bounce. Seek, we're up 3%, held it for 3 months. Xero's been our longer term hold, which is, we bought in April 2020. We're down 25%, having been up a long way, but we have trimmed that position throughout. So just speaking around portfolio tilts on the growth portfolio, Sean, what do you think that those tilts look like going into calendar 23?
Okay, I think that I'll put my hand up first and foremost and say, I thought the tech space was a very good place to be from October, November. I thought, okay, we're going to see a pullback in bond yields, which is exactly what we saw. And we're going to see people square off their underweight stroke short positions in tech. That hasn't happened. Or it has happened in spots. Like you say, Altium's gone very well for us. Seek's made us a cappuccino at best, and REA is losing us money. So it hasn't really materialized that the tech stocks have gone with that pullback in yields. Frustrating, not a disaster. Likely to be an area where we trim back into the new year. I think the metals and miners, they're probably about right. The precious metals is another area where, I don't know if you mentioned that, James, we're very overweight precious metals. We'll have a look at a stock later. I think that makes total sense. Coal and energy feels quite right.
Yeah, just on the precious metal, though, that we've rolled that into the resources exposure. So we've got now 7% of the portfolio across 2 holdings in Newcrest and Evolution. So, and that's an area that we do like.
Exactly. So we're keen on that. And real estate is an interesting one I'll talk about later when I look at the 3 specific stocks I like going forward. But real estate, which might surprise a lot of people, historically does well in a recession, especially the second half of the recession. We've got 4% there at the moment. I can see that going higher over the next 6 to 12 months. So really, if I look to that portfolio right here, right now, the only part of it I'm not overly comfortable with is the technology side of things, James. I think it's a bit heavy.
Yeah, and at the end of the day, you've got, I was talking about this, we were talking about this morning, Sean and I, just around a couple of our technology holdings and thoughts around those. So obviously there's macro, like you've got to have, we have a top-down view of where we want to be from a sector point of view, and then we populate stocks, and we look at stocks from a bottom-up perspective, but we populate those into our broader approach to portfolio construction. So we want to be tilted towards technology, and we want this sort of tilt, and these are the stocks from a bottom-up point of view that we really want to own, and these are the weightings that we need to own them at. The same is true on the materials space, and as Peter O'Connor often says on these webinars, that you get the underlying commodity price right, then you'll go a long way of getting the stock right. And I think that's true in terms of thinking about your overall sector allocations in a portfolio. So you get the macroeconomic view right, and that has a big bearing on how you get your sector allocations right in the portfolio. And ultimately, then you can create a structure about what stocks to own and in how much quantity you want to own those stocks. So that gives you a flavour for how we approach markets in that respect.
Exactly. And, we're looking at the market. It's still trading, I think, about 13, 14%. Every time I look at the screen today, it's gone higher off of the October lows. So, if we do trim back that tech space over the coming days and weeks, the likelihood is it will be into more conservative positions, slightly more defensive positions into next year.
Yeah, I mean, and I'll just stress this growth portfolio has been outperforming. So a broader market. I look at what a lot of fund managers are doing out there in terms of their performance, and a lot of growth managers have had really a very dismal 12 months. Many are underperforming quite significantly over the period, and there's been very few bright spots. So as a growth manager, I don't want to, we don't just own growth stocks in this growth portfolio. We own stocks that we think we can make money out of. And that's how you should be thinking about our growth portfolio. There was a question through the Q&A pipe a week or so ago, just around, is Telstra really a growth stock? Well, it can be, as long as we get as long as we see growth in our capital over time, Sean.
Exactly, and that was I remember answering that with you and thinking just that I do care what the stocks are, but Zip was a growth stock this year and it's undone a lot of people. We got caught a bit with it as well. Just because a stock has got a growth tag, if it goes down in price, it doesn't necessarily want to be sitting in our growth portfolio.
All right, I'm going to move on and get onto stocks in just a minute, just in terms of the income portfolio tilt. So we've got more of we don't have technology because they don't pay, they don't have very predictable earnings, and they don't pay a predictable dividend. We have right at the moment, we have 44% of the income portfolio in income type securities. So that's split by about 25% in hybrids, then about 20% in bonds and other listed income securities. So that's why you get a lot less volatility in that portfolio, a lot more stability in terms of returns out of that portfolio. So that the moves that we've made in recent times, we've just trimmed some. We sold out of APA Group, we sold out of AGL, and we trimmed BHP. All of those were on APA and AGL. Were all on valuation grounds. And the last buy we've done in that portfolio is Dexus. So we were speaking about property just recently, and we stepped up and bought Dexus. So it gives you a feeling for how we sort of approach that income portfolio. We're trying to be sellers of strength, buyers of weakness, whilst consistently delivering a yield in excess of 6% in that portfolio, plus a high degree of franking. So that gives you a sense of how we manage the portfolio tilts in the income portfolio. Now, Sean, let's move on to 3 growth stocks that we like right here. This is a scary chart because it's gone up so much. Why is Whitehaven still on this presentation, Sean? You're muted there, mate.
Oh, sorry. Quickly go back to what a phrase you used there before, because it's quite apt here. I said earlier in the year that I thought 2022 would be a year to buy weakness, sell strength with an emphasis on the selling side of the equation. And I think next year might be the same. This is one stock that most definitely has not followed that rule. And we took profit at one stage too early. We did buy back in on that sharp dip down last month towards $8, or in fact, it went below $8. This is there was a lot of moving parts here with Whitehaven. It is simply printing cash. It is making an absolute fortune. If we look forward,
as long as the coal price stays where it is.
Well, of course. I mean, it's a cyclical beast, but we are entering. And for anyone that listened to Rocky and James discussing the resources in a great webinar we did, I think it was last month, we are entering the Northern Hemisphere winter, or we're well and truly in the middle of it now. And as some of you can probably tell from my accent, I've got a bit of English in me. And the place is under, 3 foot of snow in most places. They are having a really, really cold winter, or the start of a really cold winter in the Northern Hemisphere. And it's quite straightforward. When it's that cold, they are using more coal. And as they use more coal, the coal price goes up. My view is that with the buybacks that are going on, and Whitehaven Coal is caught between 2 scenarios. It's currently, as James said, with the coal price where it is, making an absolute fortune. And its biggest problem at the moment is a delightful problem. Do we do buybacks and keep the overseas investors happy? Or do we pay fully franked dividends and keep the local investors happy? And in fact, of course, it's doing a bit of both. But the way the momentum behind the share price, what we're seeing overseas with the weather in the Northern Hemisphere, which is it just so happens to be helping us by being particularly bad, but I still think it would be incredibly supportive. And we're also seeing on the policy front a number of governments in countries, people like Lloyd's of London, people don't want to be involved in backing new coal production. So I think the supply side of the curve in the coming years will be a problem as well. So the easy thing to do would be to look at Whitehaven Coal and say, oh, let's take profit. We've had a horrible year. I still think we'll see the stock trade at $12, $11.50, $12. I know in the scheme of things that might not seem very far, but if we can pick up 20%, excuse me, in the coming weeks, which would make this position a phenomenal position in terms of how long we've held it, I think it's great. I think it is a very, very volatile stock. It's got the capability, as we've seen a few times this year, to swing around in 25, 30% on the downside, significantly more on the upside. It's going up at the moment. Once we get through that Northern Hemisphere winter, it could have another pullback to $8. It wouldn't vaguely surprise me, vaguely. But for now, I think this is a beast to hold. Stay long. If you haven't bought it, it might still have a bit of legs in it. Obviously, the easy money, if such a thing exists, or the good risk reward, not easy money, is behind us. But I think I'm happy to stay long Whitehaven. Hopefully, I'm not giving it the kiss of death, but I think we'll see new highs in the coming weeks.
Yeah, so just to it was funny how the right at the start of the European winter it was less cold, and that's what put coal prices on the back foot, and that's what saw the price down below $8 a share. Now the weather's kicked in, it's rallied again because those markets are simply so tight. So when high supply meets a tight market, you get prices go up. Just to give you some flavour around Whitehaven, they paid 48 cents in dividends in FY in 2022. That's about 65 cents if you include franking. They've bought 34 million shares back of their buyback. They've got another 206 million shares to buy back. So that's a couple of $1 billion to spend on buybacks, and they're doing about 50% in terms of buybacks and about 50% of capital returns via dividends. So we think that's one to stay long. And we own New Hope in our income portfolio as well. So if you focus on dividends, New Hope's going to pay more out in dividends and do less buybacks. If your focus is on total return, I think Whitehaven will probably do better through that 50% split of dividends and buybacks. They're trading on like sub 3 times FY23 expected earnings. So anyway, from the good, Sean, to the not so good, James Hardie. This guy's just to set the scene. So it is trading at 52-week lows. It's down 50% year to date. It trades on right now. It's trading on an estimated P of 12 times. It normally trades on 20 times. So it's had a massive re-rate. Makes it about 35-40% cheap on my quick maths there. Why catch a falling knife, Sean, here?
Okay, well, this is probably the opposite of Whitehaven in lots of ways. One thing I've very quickly to add on the Whitehaven story, it's only a $9 billion, less than a $10 billion company. So if they're doing $2 billion worth of buybacks, that puts things in perspective. So coming back to James Hardie, we've gone long in recent weeks looking for an improvement in the stock. And then we had last week, earlier this week, US home builders sentiment has come out now at more than decade lows. So it's actually still weaker than we first thought. And I think, on balance, this is a stock where we've probably gone too early. So then we got to decide, okay, we've gone a bit early. We bought the falling knife, as James has rightly pointed out. Should we get out and look to buy back in lower? And we still might do that. I've never taken these things off the table. All of our positions are fluid. They're constantly under discussion between James and myself in this particular portfolio, especially. But as I've said earlier, and we obviously have to have a certain amount of our portfolio in shares, and real estate is a sector of the market that outperforms in a recession, outperforms when everything looks worse. So can things look worse from a recession point of view, from a property point of view? Of course they can. Without doubt, of course they can, and they might well do. But, James Hardie has already halved. It already is, as James said, trading basically below half of what it normally would from a valuation perspective. So it's got a phenomenal amount of bad news in there. I would probably say it's ideally an accumulate. I wish we'd bought a smaller amount, leaving us room to buy a bit more weakness. But I do believe this is a stock which will be trading a lot higher in 6 to 18 months' time. I know that's a very, very wide window. And I'm sort of dodging bullets when I say that, but I think it's a quality company that's been caught up in a bad macro environment. It's not necessarily doing anything too badly itself.
So there's a lot of negativity towards US builders, and we keep talking about US builders because 80% of their earnings come out of the US. So US is the key to this stock. We're saying that a lot of the negativity that we're hearing at the moment is already priced into James Hardie. Whether or not 27.44 will be the turning point or not, who knows? But when they do turn, there will be this change of sentiment, which will re-rate the earnings multiple investors are prepared to pay on this stock. So moves higher on the upside will be more aggressive, in my view, now than moves on the downside, because we've had that PE re-rate lower. So we've gone from 20 times earnings to 12, and then on the upside, you'll get that PE re-rate again. So we think what James Hardie is certainly a stock that we can be buying here. And then finally, very quickly, Sean, because is just the ducks are aligning for gold stocks. We've got Evolution on the chart there. It's been a horror 18 months or so for gold, but the last couple of months have been better. What's your take?
Gold stocks, to use a phrase, I listened to Rocky's resources commentary earlier, and he said it. He summed it up. Gold stocks are by far the cheapest resource companies on the market at the moment. A lot of them are trading around, still even after the recent strength, they're still trading around 50% of their underlying fair value. If the gold price continues to be firm, forget about going up. These gold stocks are extremely cheap. They're under-owned. People aren't long, same sort of thing, however you want to put it. We feel this is another classic example of re-rating. I can see Evolution going above $4 very, very easily, which in terms of how far it's fallen might not seem like a big deal, but it's still 30-odd%. It's a huge amount, and it could go as high as $5. We've got the gold price in both Australian dollar terms, in US dollar terms, has broken a multi-year downtrend. We saw the moves yesterday by the Bank of Japan. They've come out, looks like they're going to start to tweak or maybe even actually embark on a whole new direction with their policy. In other words, raising bond yields, raising interest rates. That can change a decade trend of the dollar yen. All these things point to the US dollar, which James touched on earlier, struggling to maintain the strength which we've seen for many, many years. And a lot of people have assumed that's going to be the case. Don't forget, we've now got a lot of people actually believe the US dollar goes lower. If people believe the US dollar goes lower, one of the best proxies to buy that position are incredibly cheap gold stocks. And we're seeing that at the moment. I think Evolution today, it's not on that chart, is up about 7%. Now, of course, one day doesn't make a summer, but it's still nice to be talking like that when it's up that much in one day.
Yeah, it's a great. This is a stock that I really like. I think in the next 12 months we'll see it at significantly higher levels, and I think it's I'm glad we backed it. We've got Newcrest in the growth portfolio as well, and we've got a more speculative play in St Barbara, which has just done a really interesting deal with Genesis in the Leonora region in WA to create a really strong third tier gold company. So that I was just looking at our portfolio reports this morning. St Barbara was up 16% on the week, but we think that's that deal was done with St Barbara trading at about 0.5 of NPV, net present value. So something that we like in the gold space there. I'm going to move on to the income space now, and as Sean was rightly pointing out before, just around real estate stocks tend to bottom out. There's been a huge amount of pain right through the real estate space. So Centuria Capital is actually a real estate funds management company, so they're a little bit different to a real estate investment trust. They do have stakes in real estate investment trusts, so they own 14% of Centuria Office Fund they own. I think it's about 16% of Centuria Industrial REIT. They then manage a bunch of unlisted trusts, so unlisted property trusts. They recently, a couple of years ago now, they took over Prime West to get a footing in WA, etc. Anyway, long story short, these guys are leveraged to property. They can do deals and they can make money out of downturns. So it's a really well-run company. It's clearly had a huge pullback in share price. We own this one in our income portfolio as well as our emerging companies portfolio. We're down marginally on both of those, across both of those portfolios, but we like it here. It's small, it's not large. It's $1.4 billion market cap company. It's yielding about 5% next year, but that'll go up over time. And we think it's got a lot of upside in terms of CNI at the moment as an income position that we like. That's slightly higher risk, but we can really make some money out of this one next year, I think, Sean.
Oh, totally. And I think it's one of those stocks. In fact, the whole sector looks cheap, and that word I used earlier, accumulation. It's in that accumulation area.
Yeah, I touched on obviously Centuria is one. The most recent stock that we've bought in the income portfolio is Dexus. Now we contemplated buying this for a long time. Dexus is trading at like 30% discount to its asset value, but are things going to be as bad as that in property over the next 12 months, particularly in office? We've seen some revaluations come through for these property companies. So Dexus got their properties revalued externally, and they were down only marginally. They were down less than the market was expecting. The market's pricing a lot of scorched earth sort of scenario in property. So something like Dexus is trading at a huge discount to an assets. CNI is trading a big discount as well. Moving on to Metcash. So we've touched on this a heap of times. So I'm not going to focus too heavily, but I just wanted to highlight it because they went ex-dividend yesterday. The 11.5 dividend went ex yesterday, fully franked, but the stock was down about 24%, 24 cents, I should say. So back around that $4 mark, we really like it. It's yielding, it's trading on 13 times, yielding 6.1%. They've got the thing that we like about this. So they've got about 55% of their earnings in food, about 27% in liquor, and about 18% in hardware. It's that hardware area that's growing more strongly than the others at a quicker rate than the others. 2 years ago, it was 14% of their earnings. So you think about if they can grow earnings quicker, driven by hardware, still have the defensive qualities of food and liquor, but the overall earnings growth ticks up, then you get an up rate or an uptick in that multiple that the market is prepared to pay. So that should be 15 times earnings or so from 13 times. And then you can get some reasonable appreciation in share price along with a good dividend along the way and an earnings stream that's fairly defensive. So that's why we're highlighting Metcash there. And we're talking about the other supermarkets in a couple of reports a little while ago, Sean, saying they might feature in our portfolios next year.
Exactly. I mean, it might be boring. We might put Metcash across the board. But Woolworths, etc., they look okay. People have got to eat. I hate to use a very, very boring, I should say, often trotted out phrase, but people do need to eat. Their margins have been struggling, but the supply chains have improved. They have got beyond the COVID hump. So I think that, the supermarkets are looking okay. Yeah.
So if inflation, the expectation is inflation will be lower this time in 12 months. So that's going to, supply chains are going to ease up. Labor tightness in the labor market is probably going to ease as well. So that suggests that supply chains are going to sort themselves out a little bit. And now just on the bank, Sean, I put this in there because it's our last position that we bought across our flagship growth portfolio and our income portfolio last week. NAB across the banking space, but it obviously speaks more broadly to our banks. We've only got 18% of our portfolio, our growth portfolio in the banking space, so we're underweight at the moment. Take us through some of your views into early 23 on the banks.
I think the banks are really, really well positioned. They're solid company. I mean, Commonwealth Bank is only a couple of percent of all-time highs. I know that's the role.
CBA, yeah.
Exactly. Yep. But that just put things in perspective. It's almost at an all-time high. If you just had a portfolio, which a lot of Australian people do, which is dominated by CBA, you'd be talking about what bear market? I've got my nice big fat dividends, and the stocks are still trading at where it is, or if not higher than where it was. You take out the blip from COVID, and these stocks have hardly had a pullback. I mean, look at NAB there; it's trading well above the pre-COVID levels. So, I think we've got this at the moment. Their margins are looking good. We've got a situation where it all comes down to bad debt, James. If the bad debts aren't too bad in the recession that's supposedly on the horizon, I don't think we'll probably get an official one. But if bad debts aren't too bad, or if they're very manageable, and we all know that the banks, since the Royal Commission, have been forced to be a lot tighter with their lending. So I think the bad debts will be a lot lower than they might have been if the Royal Commission hadn't happened, which the banks didn't enjoy at the time, but it might be a godsend for them. I think they look good and they look stable, and I don't think they're going to provide any unnecessary scary surprises, and they're going to be probably trading higher in a year's time, having paid a nice dividend.
So in terms of one of the things that has surprised me in just the last little while is a couple of banks that reported in their margins, particularly their exit margins coming out of the period that they've just reported. Bendigo is the last bank to report numbers to the back end for the 5 months to November 30, and their net interest margins are improving, but their exit margins for the period are also probably improving better than expected. So that shows you that banks have got a greater leverage to rising cash rates than perhaps the market had envisaged. So, and that's why we've seen, in the last week or so, when we've seen bond yields tick up a little bit, and so more hawkish rhetoric coming out of the Bank of Japan, more hawkish rhetoric coming out of the Fed than perhaps the market was positioned for, banks have remained pretty resilient because they benefit from that uptick in interest rates. So their leverage to that thematic is something we've written about in recent months. So in terms of NAB and the broader sector, we're not overly bullish. We're not sitting here that we think NAB is going to be trading at $40 in the next 12 months. We think there's probably some small capital appreciation in terms of the banks, and we can collect dividends along the way. So we simply went out there and I guess began to neutralize an underweight position on the banks into weakness. So something like a NAB, ANZ, etc. They've pulled back 8-10% in the last little while. So we just used that short-term weakness to go and buy NAB in the last week or so, Sean.
Oh, exactly. And that's just it. We talk about it a lot, about the portfolios and the way they're structured. As you say, we were very underweight the banks, substantially underweight the banks. We've now, if you include Macquarie, taken ourselves back towards market weight. We're still underweight. And, I think that's about right. Let's wait and see what comes out next year, whether we do get a bad recession, whether the lift in home loan rates does start to really hurt people with their mortgage repayments. And if that happens, I'd be a buyer again into further weakness. So I feel quite comfortable where our levels are now.
Yeah, I don't think you want to be holder of a big overweight position in the banks when interest rates are starting to get cut, because interest rates are obviously getting cut because the economy is struggling, etc. Plus that leverage that banks have on the upside to rising interest rates in terms of the margins that they're achieving. It cuts both ways on the downside. So keep that in the back of your mind when interest rates start to head higher or start to taper off, according to the bond market at the back end of last year. A couple of questions here. Someone's Sonny's just asking, when you're talking about bond yields going down, does that include corporate bonds or just government bonds? Sean, I'll take
they normally go together. Obviously, government bonds are perceived to be less risk than corporate bonds. Corporate bonds are very, very important because that's the amount of interest that a company has to pay to borrow money. The less the quality of the company, the more obviously they have to pay from an interest rate perspective. It was only a few years ago, people may remember that big companies, whether it be BHP or Apple, more the American companies than here, but big companies, they could borrow money at sub 2%, almost nothing. And then the next thing they were doing, they were going out and doing huge buybacks. And that fuel for the stock market rally is one of the parts of the M2 chart I showed earlier. That easy money pouring into equities is gone. So coming back to answer your question, Sonny, it kind of includes both, but I have specifically been talking about government bonds today.
So bonds pay the majority of bonds pay a fixed interest rate. So when interest rates go up, all things being equal, bond prices go down. The difference between say a safe US Treasury is that they pay they're paying the interest rate. When you look at a corporate bond, there's a margin over the top of that to account for the risk you take on over and above holding a safe Treasury. So spreads can blow out, etc. But all things being equal, overall bond prices will move in line, whether that's corporate or government, and then the spread is the difference that'll move above and beyond that. We've got some Q&A happening, and we were going to end up at 12:45. We'll kick on it. I've got a couple of questions that have been submitted prior, so I'll probably just get. Do you still hold next one? Do you still hold a view on CCP? I'm just going to get let me get my some charts up so we can have a quick run through of some of these questions. So CCP, I will get a chart up of CCP so we can all be looking at it. So the last thing we wrote about that was at the start of December, looking for a squeeze up towards $25. Hasn't happened. So my view on Credit Corp, and I'll start this off, Sean, is that when you've got they obviously buy debt, distressed debt, and then try and recover it. At the moment, there hasn't been a lot of distressed debt out there, so it means that these PDLs, purchase debt ledgers, are expensive, and if down the track, if conditions start to deteriorate, then they become more difficult to realize the return that they perhaps priced them on originally. So to me, Credit Corp's in a bit of it's not one that we'll be buying anytime soon. But Sean, have you got anything to add to that?
No, I mean, we did get a squeeze up to above $20, which was in itself a 25% squeeze, but it hasn't followed through. And I could see no other comment to say to me it's neutral here, for both technically and fundamentally.
Yeah, I just think there's too many headwinds out there for Credit Corp, or uncertainties around how they're going to monetize their book. So that's the key. I mean, the market quite likes Credit Corp. They've got 4 buys on it, or 5 buys, 2 holds, and that's it. It's inexpensive, and it's got a strong yield in terms of what they're paying out in distributions, around 4%. But it's hard to get excited about that. We've got a question on just Pilbara. So we're talking about Pilbara's been one that we've spoken about a number of times. We used to hold this in our emerging companies portfolio. We sold out of it. We've previously written that we like it under 375. It's come back to 387. So this has been a pretty meaningful pullback in terms of Pilbara. Sean, what's your take on Pilbara and probably lithium more generally?
I think it's probably in the accumulation area, to use that word yet again. I'm using it a bit. I feel that these stocks do have a habit of pulling back and rallying further than you expect, because they are, very, very new. Well, Pilbara is not a new company, but the whole growth and thematic is a very new. A lot of guesswork involved, or forecasting, as people like to use, about how far they're going to go. I think under $4, Pilbara will look after you, but I would be leaving some ammunition to add to it. And it is a stock we are thinking about for the growth portfolio next year.
So we sold it out of our emerging companies portfolio up around 550. At the same time, we trimmed out of IGO. So we went down from a big overweight in IGO. I think we had 5 or 6% in the growth portfolio. We've gone down to 3. Plus we had a lot of capital gains. It was about a 40%. We're up about 40% on that position. At the moment, I'm totally agree with Sean. I think Pilbara is more in the buy side. I think next 12 months it generates a lot more revenue. They're going to start. That's going to drop down to an uptick in earnings. They're going to, as they suggested recently, they're going to start paying a dividend, which is going to be, pretty meaningful on the share price below $4. So Pilbara is one I really like. So the concern in the short term was the lithium price auction. which showed a decline for the first time in the last 13 auctions or something like that. So the lithium price could be rolling over, but it's whether or not Pilbara is already priced in that decline. So we like it as an accumulate. Just a question on Lynas. Do we like Lynas at current levels? So this is one that we've got in our emerging company, LYC. Why did I do S? LYC. So this is one we've got in our emerging companies portfolio at the moment. We like it around these levels, so around $8. But have you got anything to add from a short-term sort of a tactical standpoint, Sean?
Actually, I haven't. I hate to be boring. Around $8, around 25, where it was last time we wrote about it. To me, it seems like it's taken a rest. It's been here now for 6 months.
Yeah, it's done nothing.
It's done nothing. It's done nothing. And one thing we know from being in the market for a long time, don't try and force something on the market. Let the market come to you. So right here, right now, I'd say it needs a catalyst.
Yep. We've got there's quite a few questions coming through. Banks we've covered on the banks. There's one here saying, Sean, reposition your camera so that we can see your face, which I think is probably a good idea. I did suggest that to Sean in the last webinar we did. So thanks for that, Mitchell. In terms of, not sure you might be careful for what you wish for, Mitchell. We've got just a question coming through on BHP. When would we buy BHP? When would we be on the buy side of BHP again? I'll get that up. So just to give you an idea of our positioning on BHP, we have it in both the flagship growth portfolio and the active income portfolio. We had a sizable position in both. We trimmed it by about 3% across both portfolios in recent times, more at the top of the trading range. So what's your take, Sean?
Well, we've had the same chart up in a lot of reports over the last 6 to 12 months, which has basically said buy BHP under 35, sell BHP above 45, and we've basically done that. And I don't see any real reason from establishing a position point of view to change that. However, we have trimmed our position, which means where would we consider going back in with a relatively small amount if we wanted to build the position back up to where it was. And I would say somewhere around that, $44 area. If I was looking to buy the market, around $44, if I was holding nothing, I'd start to accumulate. It all depends on what you've got, how much you're holding. If you're holding it at all, it's a great company. It is a cyclical company, so we can see that on the chart that James has just pulled up. BHP, however good a company, however large a company is, it's very, very capable of having 30 to 40% pullbacks. Right here, right now, we're going into a recession. It's very, very resilient, but I wouldn't be surprised that sometime next year you could buy it under $44. Really, it's only a blip on that chart that we're looking at there. And that would be the first level where I would say this looks quite good here. But really, to answer your question in full, I'm still sticking with that. Buy it under 35, sell it above 45.
Yeah, so range bound. I think the thing that's interesting about BHP is obviously their move on to Oz Minerals. So news out yesterday that they're going to take another week to dot the I's and cross the T's of that transaction, but it's likely to go through. So I mean they're making a big play on copper in the outer years. So BHP is going to be, obviously now it's dominated by iron ore, but they're going to obviously branch out over the coming years, and they're going to be more of a future facing type company. So that's going to be an exciting time. But I think, I'm more of the view that we should be, we only trimmed at sort of high 46s or low 47s. So, we should be more patient going into sort of more towards that $40 level or below $40, the bottom of the range in terms of BHP. I think we'll get chances right across the board on these on companies in 23. So I think that's the key takeaway. And I know there's quite a few questions still there that we haven't answered that we'll get to in our reports, but I think that's the key takeaway going into 23 that we want to stress with our subscribers, whether they be existing subscribers who have been with us for quite a while, who are really across our views, or new subscribers, and we welcome all those new subscribers to Market Matters that have come on through the Christmas offers that have been put out. Welcome. We hope you feel support, the environment, the support of the community, and in Market Matters, and we continue to look look forward to continue to deliver really good content to our users. So on that, I'll leave that. I wish everyone a very Merry Christmas. After what's been a very tough year, Sean, in terms of markets, I suggested before that the S&P was down 20%. Our market's down a bit, but nothing like that. But it has been a pretty tiring year across markets, I've got to say.
Oh, absolutely. I'm looking forward to a few weeks off, James. And I think I spoke to a couple of subscribers this morning, and they were feeling like it's been an awful year. But as you say, if you include dividends, it really hasn't done a lot more than tread water.
No, it hasn't. And I can sit here and say that if I look at the portfolio performance of the Market Matters portfolios, and I ran through this yesterday, the growth portfolio is up for the year. It's up a few percent for the year, but against the market that was that is lower. We'll take that after a pretty challenging year. The income portfolio was up about 6% for the year, with a lot less volatility. The international equities portfolio and the emerging companies portfolio, I don't know off the top of my head, the emerging companies portfolio was down, and so is the small ords. So the small cap stocks out there have been really hit. So I think it's down about 16%, that index, for the year. So it depends where you've been in the market, Sean, is probably the key thing I'd like to stress that. And I think it's going to be the same in 2023.
No, exactly. I would add there an interesting point. The small caps index is a very good leading indicator for where the bigger market is going. And that's why one of the reasons I think that next year could be not so much challenging is right. It could be a great year, but I think we have to be open-minded and flexible. And the reason I say that is the small cap index is a great indicator, again, excuse me to use that word twice, of liquidity. But it's one of people buy their BHPs and they buy their CBAs, but they normally keep 10 or 20% of their portfolio to the smaller end of town, and they haven't got as much money to be doing that at the moment.
Yeah, we'll leave it there. Like to summarize our view, and I'll just pick up on those points. We think probably the start of next year could be pretty challenging, but we think there's going to be some really great opportunities after a difficult Q1 of next year, and perhaps the next bull market is only around the corner. So with that, we'll leave you. Merry Christmas to you all. Thank you very much for your continued support of Market Matters. And the broader Market Matters team really appreciate it. Thanks for supporting us, and we'll support you going into next year. Bye for now, guys.
Bye, guys.